having an insurance policy like Bitcoin is really important in emerging markets. Bitcoin is backed by the largest computer network in the world, and therefore it is the safest cryptocurrency or crypto asset out there.
Cathie Wood begins by highlighting the resilience of Bitcoin, emphasizing that there's no way to shut it down. She points out that even after China's efforts to suppress Bitcoin activity within its borders, the activity merely migrated to other regions. This adaptability and decentralization are central to Bitcoin's strength. There's no central authority or throat to choke, making it virtually unstoppable. Wood stresses that Bitcoin plays a crucial role, especially in emerging markets, where economic instability is often rampant. In countries where leaders may not fully grasp economic principles or where corruption is prevalent, citizens can experience severe devaluation of their currencies. For instance, Wood mentions the 40% devaluation of the Egyptian pound in early 2023. In such scenarios, Bitcoin acts as an essential insurance policy, preserving purchasing power and wealth in the face of economic turmoil. Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
There's no way to shut Bitcoin down. And China tried. And all the activity that was in China just migrated. There's no oversight. There's no throat to choke. And it has proliferated to such an extent and is serving a really important role, especially in emerging markets, where people, of various countries, if their leaders either don't understand economics or there's corruption, and they lose purchasing power and wealth, to the tune of 50% in a very short period of time. Even this year, Egypt, I think it was the beginning of March, devalued the Egyptian pound by 40%. And so having an insurance policy like Bitcoin is really important in emerging markets. Bitcoin is backed by the largest computer network in the world, and therefore it is the safest cryptocurrency or crypto asset out there. It has not been hacked. The base layer has not been hacked. I don't think any other crypto asset can say that. So, this is like a giant neighborhood watch. You've got a lot of people whose livelihoods have been built on Bitcoin, starting with the miners in the Bitcoin ecosystem, and they are all watching to make sure that this ecosystem is as robust and hack-proof as possible. Well, there is one thing that the Bitcoin community is watching, and that is quantum computing. But as I always say, when it comes to risks, half of the solution is understanding the problem. And so now developers are thinking in terms of quantum proofing. So I think that is something we should consider seriously, and I'm happy that the developers are considering it seriously because, again, half the solution. Well, many people would call drawbacks like higher cost than other solutions, slower transaction settlement times. But to us, those are features, not flaws, because it's part of why it is the safest ecosystem in the crypto asset world. So we don't look at those as issues. We look at them as really they've been built into the ecosystem to assure its success as the safest crypto asset ecosystem. What has happened, the U.S. has been the worst. Gary Gensler, as I've said many times, has been a menace to our ecosystem and has pushed a lot of innovation associated with Bitcoin and other crypto assets into the rest of the world. So much so that many of the innovators who have moved to other parts of the world, whether it's Switzerland or Berlin or London or Hong Kong, Singapore, they will not deal with U.S. investors even. That's how bad it got. They think they'll be tainted because we are regulated by U.S. regulators. You know, when you're a regulator, there's a lot of power seeking, and we know the history of the SEC and the CFTC. They've butted heads over the years, right? And we saw this during the derivatives, the evolution of derivatives in the 90s. And finally, with, I think, a Supreme Court ruling, they both regulate it, but regulate different parts of it. That is what I think was going on. There's a power struggle in the regulatory ecosystem. This is my purview. And so we may go to the Supreme Court again. I don't know. I think that was the main issue. But now there's something called regulatory arbitrage. And so that's what I mean by other countries very interested in attracting innovation are one-upping us.
Shifting her focus to the broader economy, Wood predicts a deflationary period that most people have never experienced. She draws parallels to the Great Depression, the last time deflation was a significant economic force. Companies that are highly leveraged and fail to anticipate falling prices will find themselves in trouble, as servicing debt becomes increasingly difficult in a deflationary environment. Wood outlines two primary reasons for her deflationary outlook. First, the COVID-19 pandemic led to supply shocks that allowed companies to raise prices significantly by as much as 20% in some cases. However, real wages did not keep pace with these price increases, leading to a decline in consumers' purchasing power. The saving rate in the U.S. has plummeted from a peak of 32% during the pandemic to just 3.9%, a historically low level. This decline in savings, coupled with rising concerns about job security, particularly among those earning more than $100,000 a year, signals a weakening economy. The second reason for deflation is technological innovation.
I really think we're going into a deflationary period, and most people have never seen that. In fact, it really hasn't existed since the Great Depression. And any company that is highly leveraged and doesn't understand that prices are going to be falling for two reasons, I'll get into that in a moment. Any company that does not understand that and has a lot of debt is going to be in trouble, because falling prices means it will be very hard to service that debt, certainly the way they expect it to. There are two reasons we think prices are going to fall. Yeah. One, during COVID and the supply shock, it was almost permission for companies who would never raise prices by 20% to raise them by 20%, which they did, including cereal companies, and a lot of necessities. Real wages did not go up that much. Maybe they did for some union workers that got 10% per year for 4 years. But that's not many people. In fact, probably that's certainly less than 10% of the people in the United States, probably less than 5%. The rest, their real wages didn't go up. Their wages didn't go up to compensate for that. And so now we're starting to see the saving rate, which hit 32% when there was all this fiscal stimulus, just giving checks for not working. Now those are gone. So the saving rate has gone from 32% at the peak to 3.9%. Very low by historical standards. And we're also getting to a point where, if you look at various surveys, people who are making more than $100,000 a year, so roughly 2 times the national average, the percentage worried about losing their jobs is increasing dramatically. And I think that's because of all the tech layoffs, a lot of tech layoffs, if you've noticed. And that's because they're harnessing artificial intelligence as their margins are under pressure. So we're seeing prices go down and hitting profit margins. What happens? What is the easiest way to salvage those margins? The easiest way is to, unfortunately, lay people off if you have technology to take over what they're doing. Because labor is the biggest cost in an organization for the most part. So I do think the unemployment rate is going to go up, and cyclically prices are coming down. You know, we're hearing about every day there are prices coming down. So Walmart's cutting prices on either 5,000 or 7,000 different items. Target, of course, and Costco as well. Best Buy. So we're seeing this now more broadly, food away from home, definitely. That's a bad reason. That's cyclical pressures. The good reason is innovation. I just gave you some statistics on how quickly costs are falling. If those companies are smart, they're turning those cost declines into price declines so that the units can continue to proliferate and drive costs down. Economies of scale, efficiencies. And so that's a good reason. Why? Because when you cut prices in these new technologies, units boom. Okay, that's good for the economy.
Cathie Wood's insights offer a comprehensive view of the current and future state of the global economy, with a particular focus on Bitcoin and the broader cryptocurrency market. She underscores the importance of Bitcoin as a secure, decentralized asset that plays a vital role in protecting wealth in unstable economies. Despite the challenges posed by U.S. regulations and the potential threat of quantum computing, Wood remains optimistic about Bitcoin's future. Moreover, her warning about an impending deflationary period serves as a crucial reminder for investors to prepare for a new economic reality. As companies navigate falling prices and adopt new technologies, those that fail to adapt could face significant challenges. Thanks for watching. If you enjoyed this video, don't forget to like, share, and subscribe for more insights on investment strategies and financial tips. Leave your questions and comments below. I'd love to hear from you. See you in the next video.